Hello, everyone, and welcome into crushthestreet.com. What a treat we have today. Ross Beaty is on the line, inducted into the Canadian Mining Hall of Fame in 2018, a real resource legend. 13 of his companies created an estimated $6 billion of shareholder value since 1994. Starting off as a geologist and obviously moving on to a successful entrepreneur. It's a real treat to speak with the man himself today. Ross, thanks for coming on Crush the Street with me.
My pleasure.
Ross, there's riots in the streets here in the U.S., not in Canada, but we have these global lockdowns around the world with the virus, massive economic woes. Let's start off here. I mean, when you decided to get into the resource sector, is this what you were factoring in to play into what is going to drive gold and silver higher?
Heavens no. I was, I started this game back in the 80s. I spent most of the 70s going to school, becoming a geologist because I wanted a job that took me outdoors. And I became a geologist, started my little geology company because I discovered I was unemployable. I was one of these people who just had to kind of work for himself. And so I started my first little geology company, and then I started my first public company in 1985. With $3,000 and took it public on the Vancouver Stock Exchange, which is a Wild West stock exchange then with very cheap entry costs and not very many rules. So that company was a success because we found a gold mine of all things. We were looking everywhere, but most geologists spend their whole careers not finding anything. They work with other companies and they look, but they don't find it. It's a really hard thing to find a gold mine, but we did, and we were able to sell it to a major company, and that company, our first company, was sold, and so I started another one the next day, and another one, and another one, and another one. It just kind of went on like that. So when you do these things at the start, you're young and you're foolish, and I mean, I made so many crazy, dumb mistakes. Like I just can't believe some of the things I did then that I would never do now, having learned. I'm making new mistakes today, different ones, but. You don't think about macro markets particularly, at least I didn't then. I just wanted to put my head down and try to make $1 of shareholder money become $2. And you do that in this business. It's a great business to do it. And if you are lucky, because if you drill a hole, spend a few $100,000 drilling some holes, you might find a deposit worth hundreds of millions. And that's exactly what we did. So amazing. It does create fundamental value. We were bought, and then the next company was Pan American Silver, which we started out as a shell. It was 10-cent share price, no money, no people, no nothing. But we had a vision to build a real silver mining company. There was nothing in the market then that offered investors real leverage to silver, buying equities. And so I said, well, I'm going to go build a real silver company, and we did. And now I think we're the preeminent silver mining company in the world. And so investors are flocking to Pan American Silver in this time when they feel the prospects for silver are pretty good. I have to say, though, after a whole bunch of other companies, there were 6 companies in the copper business. There was a nickel company. There was there's different metals. Today, I am looking at the macro environment much more than I did then. And that's really what informed my investment in the gold business starting at about 2015, 2016, because I was convinced that gold was at a low and was likely to go higher based on the macro forces in the world. All of this happened before COVID, before George Floyd, any of that stuff. It was just a view that countries were devaluing their currencies or debasing their currencies, that there was too much debt, that major markets were too high, there was a bubble that was due to be popped. And I didn't know whether COVID was going to do it or what. It just was a conviction that gold was likely to go higher. And sure enough, it bottomed in early 2016 at $10.50 an ounce. Today at $17.50, and it has responded to what I thought would come. And rather than just being an academic exercise of, isn't this industry, maybe I should buy a little bit of gold. I had just sold in 2017 a renewable energy company that I'd started, and felt that, well, okay, I've got one more company left in me. I'm going to make it a big gold company. And so we started Equinox Gold more or less from scratch at the end of 2017. It's 2.5 years old now. And we've really worked hard to build a vehicle for investors who want to buy a real play on gold as an alternative to buying bullion or the gold ETF. And so Equinox Gold is a pure gold play. We've grown like crazy. We have 6 operating mines now in 3 countries, in Brazil, Mexico, and the United States. We're building another mine now in California. We're building another one in Brazil shortly. We're expanding one in Mexico. And out of all of this, by the end of next year, Equinox Gold should be producing at an annual rate of about 1 million ounces of gold a year. And we should have reserves and resources of over 20 million ounces. So, that offers really good leverage to people. If there's $100 move in gold and we're producing 1 million ounces a year, that's $100 million all reported to the bottom line per year. And so profitability is significant. And so I think we've pretty well satisfied that mission to use these things you just talked about, the fear, the kind of chaos that's going on in the world, the debasement of national currencies, the huge amounts of debt, to provide investors an alternative to buying either physical gold or major metal markets. That's what Equinox Gold is all about.
Ross, talking about these drill hole successes, how important would you say timing was in regards to a bull market?
Yeah,
to these successes?
Oh, super important. I mean, super important. Timing is a reality. These are cyclical markets. Metal markets are always cyclical. In fact, major markets are also cyclical, and a lot of people have forgotten that. They move. Bull markets beget bull markets. People make money. They tend to buy more stock. All of a sudden, it gets to some peak, and it starts to slide. It becomes a bear market. People lose money. They don't want to invest in new stocks. Stocks go lower and lower and lower. That's just how these things work. Metal markets are the same thing. When a metal price goes high, people stop buying it. Normal supply and demand laws. They stop buying it, and they look for other things to buy, and that tops out that market, whether it's copper or iron ore or gold. So things are cyclical, and I've lived that very much in when I've started companies and how I've built companies. When it's a bear market, it's actually a good time to start a company because the asset prices are cheap. And when you're trying to put together a bunch of projects for a company, you want to do it when prices are cheap. It's harder to raise money then, but it's certainly more value if you buy things at the bottom. And by the same token, at the top, when you want to be selling them, divesting these if that's your business plan, or cashing up and not buying things if you're an operating company and acquire, just taking a pause. So timing is important. Cycles are real, and it's very dependent on where you are in the cycle as to how you behave as an entrepreneur.
Ross, I'd like to get your thoughts on silver. We've seen silver really be impacted by economic news, the industrial component as of lately. But when you look at silver nominally, it's trading for roughly a third of where it was in 1980. I mean, there's really not many things out there, if anything, especially in the commodity space, you can look and say what's trading for a third of where it was, 40 years ago. So, what's your thoughts on silver, especially in this environment? We're starting to see silver move here and catch up a little bit, but really we're only talking about $18 silver. It's not that exciting when people are excited about the move we've seen, but it's really not that exciting in the grand picture.
For sure. Silver is an industrial metal and a precious metal. That's the thing that this makes silver quite unique. It's both a long-term store of value that's been cherished by generations for thousands of years. And it's also a metal that is the most widely used of all metals. It's the most indispensable metal in more applications than any other metal. So when there's an economic downturn, it's used less, and that's bearish for the price. So that's what's happened to copper and nickel and zinc and all those other metals. They've been hammered by a downturn in Chinese demand and also the COVID collapse of demand. They've been really hurt, and silver's been hurt along with them because fundamentally it is very, very big. The component of its demand is industrial demand, and you can't avoid that. Luckily for silver, it's also a precious metal. So a lot of people buy silver as a store of value the way they do gold. In fact, some people buy more silver than gold. And so it's pulled up with the macro bull market for gold that we're seeing right now. some of that is hitting silver. So silver's not as badly affected as, say, copper or some of the other base metals, but it's not as healthy as gold. And therefore, you've seen the gold-silver ratio go up and up and up and up. At some point, that's going to stop and turn around, and I suspect that's happening right now. The real question for me in the future is what's going to happen to industrial demand, going forward? How are things going to be the same, or how are things going to be different? If things are the same, if we return to a healthy global economy, you're going to see silver do extremely well, both as an industrial metal and probably as a precious metal. And probably in that environment, it would be the perfect storm for silver. It would be outperforming gold and everything else. It'll probably be the best performing metal. And the last time it did that, by the way, was in 2009 to 2011, when silver outperformed gold and everything else, and went from, I think a bottom there was around $8 or $9 an ounce, up to as high as almost $50 an ounce, back in just as recent as 2011. So that could happen again. If I was to bet on that, I don't think it will. I think that we are in for a longer term sort of depression or depressed markets, certainly recession, that's induced by this COVID shutdown, than a bullish market returning quickly. I mean, there's a lot of stimulus that's coming on. Maybe that'll have an impact, but my guess is it won't have as big an impact as it might otherwise have. Maybe I'm wrong, but if that happens, you're going to see gold still do well. Silver will do pretty well, but not as well as it would otherwise do.
Ross, would you say that this bull market that we're in has resembled any of the other bull markets you've seen in the past, or are they all different in their own way? I mean, the sentiment, sure, the investor sentiment, because as you discussed, we saw gold bottom out there end of 2015, early 2016. And everyone got really excited about that. But then we went into 2017 and 2018. Things just felt like we were in the middle of a bear market. And then it wasn't until really 2019 into 2020 where it's like, oh, wow, we really have come a long way. But I feel like it's just, you don't know that until you're halfway through or in the early stages of it at least.
Yeah, I mean, every bull market is a little different and a little bit the same, right? Plus ça change, plus c'est la même chose. The factors that govern markets are kind of the same and will always be the same. Fear and greed and those kind of things. Basic laws of supply and demand, that doesn't change. But what causes the drop in supply or an increase in supply or a drop in demand or an increase in demand, that's what changes. And I think you have to also look at every metal on its own. They're all different. Silver is different from gold. It's not going to behave like gold. The silver-gold ratio means absolutely nothing in terms of fundamental value, any more than the oil to gas ratio means anything anymore. It used to once, but then when oil and gas disconnected, they still are disconnected today. They're different commodities, and it's the same with every single metal. So you've really got to look at the laws of supply and demand, metal by metal. And the laws of supply and demand are highly affected by global events and global phenomena. And the people who get it right are the people who kind of understand what's happening in the world. And how do they do that? They read a lot, they travel a lot, if they can, and they inform themselves about what's happening, not just in the United States, what's happening in China or Europe or Africa and so on. And that to me is one thing I've benefited from in my life is a love of travel and a love of getting out to see things how they really are. And I think a lot of investors sort of miss that and don't take that into context. They get kind of focused on a small market or even a huge market like the American market, but it's not now anymore driving the world. It's an important market, but it's not the only market. And I think so if you're trying to figure out where markets are going to go, you really have to think global and understand what's happening. Big forces.
Yeah, good words right there. And I like that you're speaking to the investors right now. And I want to follow up with this. Retail investors tend to make every mistake in the book, selling at the bottom, buying at the top, maybe buying at the bottom and selling way too early. Given your experience, what is just some general advice you'd give people who want to attempt to make money in the resource sector?
Right. I mean, it's so I'm not an investment advisor, as you know, and I just, but I have observed exactly what you said. that people, people are humans. They have a lot of fear and greed in them, and those are realities that drive markets. And it is so true that because we are in these cyclical markets that take years, investors don't have long-term timeframes. Typically, they don't have timeframes that last for years. Institutional investors often do. Retail investors often don't. And they do get in at the wrong time. They get in at the highs and they get out at the lows, and it's toxic to a portfolio of speculative stocks, especially to have that happen, because they just get blown up. The other thing that happens is it's very hard for investors to really understand the fundamentals of a lot of these companies, and so they take people's advice, and that advice isn't always as fulsome, you could say, as it might be. Plus, and it's a reality of this business, that these companies are driven, and I'm guilty. They're driven by promoters, right? The people who are behind these smaller exploration companies typically are, they're snake oil salesmen. They are, the successful ones are really, really good at parting people from their money. There are some of those really good ones, though, who are also really good at finding value and building great companies. And so it's really hard for retail investors to separate those real true snake oil salesmen that are trying to sell complete junk from those who are really selling good value. And that's because retail investors don't have the expertise to really understand, well, what do all these drill holes mean? What are all these fancy economic studies? What do they really mean? It's a language they don't understand, and it's hard. The solution to that, to me, is to try to do as much homework as you can. Try to look at the credibility of the management team, the board of directors, their track record, how the company is structured, and anyone can do that in any website of any of these companies quite easily. You've got to just do that basic homework. They also should be diversified. They should have a portfolio, not just one or two plays where they have all their eggs in one basket. They should have a bunch of baskets and a bunch of eggs, and they should be buying, if they believe in gold. Nobody's going to buy gold stocks unless they believe in gold. If you believe in gold, you should buy a couple of large cap companies that are safe and much, much less risk, less reward potential, but less risk, but they give you exposure to the metal. Some of the mid cap companies that tend to be a little more volatile. And then a basket of the juniors. And the juniors should be companies that, they've been told about, or they look at, and a newsletter writer might recommend, or a stockbroker might recommend, but they should then go in and do a little bit of their own work as well and buy a portfolio, because diversification is one of the answers to the risk reward ratio that happens in this whole sector. Of course, if the gold price goes down and you have a bunch of gold stocks, believe me, every single one is going to do badly. So if you get your timing wrong, in that sense, you're going to do really badly if you don't get lucky with the cycles. I personally think we're actually not at the start of a gold market. We're not at the end. We're sort of in the middle somewhere, maybe in the fourth or fifth inning. And this has got lots of runway left, and it could get completely crazy towards the end. So when you get into these cycles, don't sell too early. Don't make this business is one where you should be able to make 100, 200, 300, 400% gains, not 10 or 20% gains. It's a market which, thank goodness, because you have metal prices that run away, and companies have nothing to do with metal prices. It's set by world markets. It's really free money. I mean, gold's gone from 1050 to 1750 in the last few years. It's gone from 1250 to 1750 in the last year. Well, if you're a gold producer, say you produce 1 million ounces, that's $500 between 1250 and 1750 times 1 million. That's $500 million of money that you haven't earned. You earn your money by producing gold. You don't earn money by having a crazy run up in the price with no cost. There's no marketing cost. There's no effort. It's just all set by world markets. So if you're in that business, it's a wonderful, wonderful time to be in the game. You have this huge wealth creation that comes from global market changes. That's the macro world. The opposite is true too. If you get a tide that goes out because metal prices are going down, you're going to be crushed. And that's where you have to get your timing right if you're a retail investor.
That's powerful.
Yeah.
Ross, thank you so much for coming on the show with me today. If you would, maybe just share a little bit about the companies you're part of now, and maybe the short to midterm plans of each. Just a very quick
Yeah.
overview of each one. And again, thank you so much for coming on the show. Really appreciate your time.
My pleasure. Thanks for having me. I mean, my universe right now is not that big. I have a renewable energy company called Intergex. It's a big company now. It's based in Montreal, but it's a great wind, hydro, solar producer. In the mining game, I really only have four companies. One is my flagship, Pan American Silver, the world's preeminent silver play. Great company. And then Equinox Gold. It's our new one. We're going to produce about 600,000 ounces of gold this year, and we'll be expanding mines and building new mines next year, and be almost 1 million ounces by the end of next year. So that's a great play. It's a new company, and it offers investors incredible leverage to gold. And then I've got a couple of junior companies that are working, exploring and developing gold deposits. One's called Lumina Gold, Lumina, Lumina Gold. It's on the Toronto Venture Exchange, and Luminex Resources, which again is full of gold assets and joint ventures and stuff. They're both good little plays. And so that's my world.
It's an exciting time to be in the resource sector. Ross, thank you so much for being on the show with me today. I really appreciate your time.
My pleasure. Thanks for having me.